Good afternoon, ladies and gentlemen. This is Barry Norman on behalf of ETX, and welcome to our class on understanding the economics calendar. I hope everybody's had a delightful week and enjoyed their weekend and are ready to get started trading this week. Now, because ETX is a regulated provider, I must read you a risk warning, so let me get that out of the way. Trading in the financial markets can result in the loss of the amount invested. Do not trade with funds that you cannot afford to lose, and seek advice if you do not understand the risks. All information is provided in this webinar is for educational purposes only. ETX Capital and the presenter are not financial or investment advisors, and we do not recommend any securities or instruments of any kind. Any securities or instruments that are mentioned throughout are for educational purposes only. Now, for those of you that are joining us tonight through the internet or through a search in the internet and don't know much about ETX, we are a fast-growing financial services company based in London, and we are physically there. You're welcome to come by our offices, say hello, or a lot of times you'll see us on Sky or BBC News while they're doing live interviews in our office. We are authorized and regulated by the FCA, that's the Financial Conduct Authority, and we're also a member firm of the London Stock Exchange. Now, when you trade with ETX, you can trade on our ETX Trader Pro. That's our web-based trading platform. It allows you to trade from anywhere at any time. Or you can use our advanced MT4 platform, and you can set up automated trading. You can set up your expert advisors. You have advanced charts. You have everything you want on the MT4 platform, which is very popular among more accomplished traders. And then lastly, if you're just starting out, you might want to start out trading on the ETX binary platform while you learn how the markets work together. But we also, many different types of trading. If you're in the UK, you can use spread betting, otherwise CFD trading. We offer Forex trading and binary options trading. So we satisfy all of your needs. You can trade from stocks, commodities, indices, and shares. So tonight we're going to be talking about the economics calendar. And the economics calendar is a tool that fundamental analysts use to position themselves to take advantage of future currency and sometimes commodity and sometimes share movement. Although shares will respond ever so slightly to economics data, shares are more responsive to earnings data and their press releases from their companies or warnings or outlooks from their CEOs and CFOs and people like that from the individual companies. Now, the economics calendar, which is published daily, is the main trading tool for traders that use fundamental analysis as signals for entering and exiting trades. Economic and political news can change the direction of a currency pair in seconds, and fundamentals that are true in one instant can be rendered absolutely meaningless by fresh fundamentals a wee bit later. Now, the important news for trading in the Forex market is programmed months in advance, and this is the biggest benefit that you have with the economics calendar. I'm sure all of you lead hectic, busy lives. And a lot of times people say to me, especially in our technical analysis classes, I don't have the time for all that. I want something that's plain and simple, because technical analysis must be done up to the moment. Whereas the economics calendar is programmed way ahead of time, and you can sit down over the weekend when you have a couple hours without the family, or Friday night in the middle of the night, or Tuesday afternoon while you're taking your lunch break, and look at the major events that are scheduled for the week and set up what we call our trading matrix. Our trading matrix is a matrix that you use to rate these economic events, determine what you would trade, which direction you would trade it, if the outcome is this or that. Once you've got it all set up, all you have to do is wait for the data feed for the event to happen and take the number that comes out, plug it into your predetermined matrix, and just make the trade that you had time to research and prepare for ahead of time. Now, on your screen, you're looking at this week's economics calendar from investing.com. There's many economics calendars all over the internet. They're free, they're easy to get. The economics calendar does no analysis. It is strictly data feeds. Because of this, and I can't say all inclusive, I'm going to say 95% of all the economic calendars are the same with the same data. Okay. So what happens is all of this data comes from data feeds. These data feeds or from APIs that other people have. These data feeds are fed from the releasing agencies. So therefore, everybody's getting the same event, the same name of the event, the same time, and the same forecast, the same previous, and the same actual. So when you keep in mind that this is not some website or some broker or some analyst's account of what they expect based on their analysis of the current economic situation, and this is just what is expected and then what is actually comes out. So you know what you're getting is hardcore information, not like news. I mean, news, you go to, you go online searching for news on say an economic event. You search for news on the U.S. non-farm payroll report. One of them is talking about the unemployment rate fell, and so it was a great report. Another one saying it was a terrible report because new jobs were way under expectation. Another one saying it was a terrible report because wage growth was not as much as it should be. You're totally lost. Was it a good report or a bad report? They're all skewed. And sometimes the analysis is released hours and hours after the event. The economics calendar isn't. It's just straight data. Okay, so you know the number that was released for the jobs report, you know the number that was released for the unemployment, and you know the number that was released for jobs growth. It's for you to make the decisions and the analysis. So a lot of times when you're getting straight data, okay, it's easier for us to make smart decisions because you're not being dissuaded by somebody's opinion or the way they're looking at it or the way they're analyzing. So, but the first thing you have to do is you have to learn how to read the calendar, okay? And reading the calendar is not difficult. It is not something that takes you a great deal of time to read. So I'm going to pop up a live calendar on the screen. And, okay, so what we're looking at is, this is a calendar from investing.com. You can use one from Forex Street, Forex Factory. You can use one, there's one in the MT4 platform. Okay, you can use them, they're all you can use them from, MarketWatch has one, Wall Street Journal has them. They're available all over the internet. Now, like I said, 95% of them have the same exact information and data. We'll talk about what allows for the variables so you can understand where the variables might come from. Now, all of the calendars, the first thing you have to do is when you go to a calendar is make sure you set it to your local time. Okay, so that you don't make a mistake in the time. All of the calendars will offer you a time setting. Some of them will automatically default to the time in your IP address. So a lot of times they're already set up for you, but you need to check and make sure. Because a lot of them, unfortunately, get very, very confused when London goes from British summertime to GMT time. Okay. So sometimes they do make mistakes. So you have to make sure it is set in your time zone. Then they will all offer filters. Filters are very important because there is so much data being released every day that you could get lost in all of this data from all the countries. But you don't need to see Ukrainian data. You don't need to see data out of Thailand unless you're trading that particular currency. Most of us don't. But if you're trading the baht out of Thailand, then you should be looking at it. So if you click on the filter button, it will offer you all kinds of filters. First of all, you can filter down the countries, and you can change them continuously. But all the sites allow you to filter the countries. Then you can display, you can have a choice. You can either see the time of the event or how much time is left to the event on today's calendar. You can select the events that are important to you. So for instance, you notice I have bonds turned off because bonds don't really have an effect on the assets I trade. So I don't need that another thing cluttering up my calendar. And then last we have what's called sometimes important, sometimes it's called impact, sometimes it's called tier, and that tier is what it's really known as. And tier, what most people don't understand or don't realize is that almost all economics data is rated in a 3-tier system. Now these tiers are not decided by the calendar you're looking at, because again, everything on this calendar is coming from a data feed. Okay, so they just automatically insert the data that is coming from the feed. So level 1 data is the lowest rated data. That level 1 data sometimes is a second part of a bigger report or is unimportant, because don't forget, economics data was not developed for a Forex trader. Okay, none of this has been thought up, come out, or released for you to trade Forex or commodities or currencies or to trade in the markets. These are the economic reports released by a country, or almost every country around the world, that tie back to their economy. Now, what we classify as a level 1 report might be a report on employment in the nursing sector. Well, it's not important to us, but if you were a healthcare provider in that sector, that could be a crucial report to you. Or, for instance, the automobile sales report is very important to all of us. But it then has secondary reports in that automobile manufacturing report that are of no importance to us. So the first thing is we have to realize this. Okay? It's important because if you were to leave on all of the level 1, 2, and 3 reports, okay, and again, we're only going to look at the countries I have selected, which is only a handful of countries, okay, you would be lost in all of this data. Okay, this is next week's report for the major countries when we include level 1 and level 2 data. So as you can see, it goes on forever and ever and ever. So you don't need that data. Okay, you don't need to have your mind or your screen cluttered up with it because it's not going to have any effect on your trading. But you should be aware that it's there. Now, we go to level 2 data. Level 2 data is important data. Okay? Don't misunderstand me when we come to level 2. Some reports are rated level 2 and they're important, and a good deal of level 2 reports are parts of a larger, very critical report. So when you look at the U.S. non-farm payroll report, for instance, you have the new jobs created, which is a level 3, and the unemployment rate, which is a level 3, but wage growth, which is now crucially important today because unemployment in the U.S. is so low and they've been steadily creating jobs. What we're all focusing now on is wage growth. So it's an important report and it has an overall important factor. But in the scope of things, if you were to look at the real U.S. non-farm payroll report, it's hundreds and hundreds of pages long with so much data you would get lost in it. Okay, because it breaks everything down by age, region, sector, everything else. So there are things that you have to be aware of when you're looking at reports. But it's not complicated because very easy you can figure it out. When you're looking at 2 lines on the economics calendar and one's a level 3 right under a level 2, they're both released in the same country at the same time, okay, you can figure out that they're pretty much the same report. So like in the U.S., you get retail sales and then you get core retail sales. Okay, you'll get inflation, core inflation, and PPI. Okay, the difference is inflation, retail sales is all retail sales total. Core retail sales takes out a lot of the bigger items, especially automobiles, because it's such a big number, or they'll take out things like airplanes or expensive boats, because those things can, especially if somebody places an order especially like if we're looking at factory orders, somebody places an order for 10 jets for Boeing for $100 million. Well, those jets aren't going to be delivered for 5 years from now, but the order was placed, so it has an effect on factory orders right now. But if you were to look, it can skew the number. So a lot of times you have what we call core. Okay, core takes out some of the important items. But like also when we have inflation release, you have CPI and PPI. PPI is Producers Price Index. CPI is Consumer Price Index. So it's the increase in cost of goods to the producer and then increase in cost of goods to the consumer. So you have to be aware of these sub-reports, or like when you get the trade report, you'll get the trade balance, but then underneath of it in level 2, you'll see imports and exports. Because even though that number is good or bad for the trade balance report, it could be misskewed because imports fell and exports went up. Could be, so it could mean that number, even though it looks like it was a very good number, it was a very bad number because why did imports fall? So you have to be aware of level 2 reports. Level 3 are the reports that will have a tradable effect on the markets. Okay, we call them the headline report. Okay. Now, because this week is dead center in the middle of the month, we get most of our economic events the first week of a month, the first 10 days of a month, and then we get them the last 7 days of a month. So mid-month, you have reports coming out, but you don't have strategically important reports. But you still have some. And if you see, there's a good variety of level 3 reports coming this week. But we're talking about for around the world, there's not all that many. So we have on Monday morning, we have out of China, industrial production. This is a very, very important number. Okay. But we also have to figure out what this number is and also what assets would be affected by this number. You could do a little bit of this. Every calendar you look at, it's either going to have an information box, a hyperlink, somewhere to get details. In this case, we just click on the line. And what it does immediately, it opens up an explanation of the report. It'll give you the link to see the whole report. And believe me, once you've seen one of these whole reports, you don't ever want to read one again. And then it gives you some data on the previous reports below. Okay. This data is very important for you, okay, because being a new trader using the economics calendar for the first few times, you have no idea what historically this report should be. You have no idea what even amount it comes out in and how big are the moves from week to week. Like if we look at PMI reports, Purchasing Managers Index, they stay around 50. They stay between 50, 65 is fairly good, under 45 is horrible. And yet to know that 50 is a very important number because 50 is the slice line between contraction and expansion. But when we find out PMI only moves in, first of all, it moves in tenths of a percent, and it relatively moves very small amounts. So you only get that from looking at the reports below and doing a little bit of study. Again, the nice thing about the economics calendar is you have the time ahead of time to study. Now, once you've done the studies and you start trading from the calendar regularly, you're going to know most of this stuff. Because the other thing you have to remember is all the countries around the world release this data. So you have government data released, and then you also have private data like Thomson Reuters. You'll hear about Platts releasing data. Platts releases data mostly on oil and gas. Okay, but you have other releasing agencies that release very important reports. Otherwise, they're governmental reports. So once you start, though, you'll get them down pat. But like I said, every country around the world releases the same data. So PMI out of Canada is called IVY. Okay. I don't know. Well, that's the institute that started doing the report a zillion years ago. Okay. So you'll get to know these. So the important jobs report, like we talk about all the time, is the U.S. Non-Farm Payroll Report. It's a funny name, isn't it? But back a zillion years ago when they started releasing this data, the Agriculture Department released the data on agricultural or farming jobs, where the government then released another, this is the Department of Statistics and Labor and Statistics, released everything but the farming jobs. So hence, the non-farm payroll report. Okay. In Australia, it's just called the jobs report. And this week, we actually have it coming out of the UK, which is critically important in the UK. And there it's known as the claimant count. Why? Because people used to focus more on unemployment than they did on earnings growth and jobs. Okay. But it's the same report. But after a while, you'll get to know these fairly well. Now, I'm going to real quickly jump over to the right-hand side of the calendar. So, okay, let's start with the left calendar, left columns first. We have the time. We have the country and the currency that it will affect. We have the importance level, and they're all in levels of 3. Investing.com uses 3 bullheads. Forex Street uses explanation points. Somebody else looks at stars. Okay, this is one of the few things that the graphic designer for the individual site can adjust. Okay, but it's still 1, 2, and 3. Some places just use 1, 2, and 3. Forex Factory uses 3 colors because it's easy to tell the color. The computer, the number comes in 3, make it 3 bullheads. You know, these are certain little things that they try to customize and make unique to their site. After a while, like I said, you click on the line, it'll explain to you exactly what this report is. Now let's jump all the way to the right-hand side. Here we have 3 important columns: previous, forecast, and actual. Previous is very easy to explain. It's the number that came out the last time this event took place. So the weekly report is the report that came out last week. If it is a monthly report, it's the number that came out on this report last month. Now, I'm going to check you back to my PowerPoint to tell you a story. Okay, and let me get my PowerPoint back up on your screen here. And we're going to jump up to the story of your kids and their report cards. Because if you think of an economics calendar as simply as a report card on the economy, it's really what it is. Now, you're a good parent, but you don't go call the teachers, you don't go to the school board meetings, you're not involved in the school board, you're hardly even involved in the PTA. But you know what grades are, you know what A's, B's, and C's are. And you know when report cards come out, you're an active parent, but you're busy, you work, you have kids. You know, you do, but you know, you have good kids. So you're sitting down to Sunday dinner, and you say to your son, well, kiddo, report cards are due Wednesday, how did you do? And he says to you, well, Mom and Dad. Now, before you listen to him, you know in your head, your kid's a good kid, he's pretty dependable, pretty reliable, and he doesn't lie to you. So he's pretty honest. Okay. So you know that you can take whatever he's going to say and it's going to be pretty much accurate. So he says, well, Mom and Dad, if you remember right, last semester I brought you home 4 C's and 4 C pluses. They said, we remember. Okay. What is that on the economics calendar? That's the previous. It's etched in stone, except it can change a little bit. But we'll talk about that in a minute when we talk about the reports being released. Now, he said to him, well, kiddo, how do you think you did this semester? He says, well, Mom and Dad, I had a pretty good semester. I studied hard. I did fairly good in class. My reports, well, I did good on my tests. I think my homework was all on time and everything was rated just fine. I think I might do a little bit better. I'm probably going to bring you home either all C pluses or 1 or 2 B's. They say, okay, kiddo, that's good. Well, that's not bad. But of course, you're very good parents. You know, you give them the talk about less time on Facebook, less time playing soccer, more time studying. You know, it's getting down to the serious time because he wants to get in university and get some scholarship money. He needs to get those grades up. So, you know, But you're not going out to find out what his other classmates got. You're not calling the other parents, see what their kids told you. They're not doing any analysis. You're taking this number as his forecast or his projection because he's pretty reliable. Well, same thing what we get is when the forecast on the economics calendar. Almost all the numbers for the forecast come from the same place and they're exactly the same, except some of the calendars, because the forecast is not released by the releasing agency. In other words, the government doesn't put out a forecast of what they're expecting the non-farm payroll report to be a couple days before the release. So these come from analysis type organizations like Thomson Reuters, or a lot of times you'll be reading in Bloomberg or you'll be reading in Reuters and it'll say the Bloomberg survey of 36 in-house analysts expect the number to be whatever. So some of the calendars get the number from Bloomberg. Some of them get them from Reuters or Thomson Reuters, one of the reporting or one of the analysis agencies. So sometimes you will see a variation in this number. It's a very small variation. So for instance, when the U.S. non-farm payroll report comes out, sometimes one place is predicting 210,000, one place new jobs, one place is predicting 207,000 new jobs, and one place is predicting 212,000 new jobs. But this is only a forecast. It's the most you can do is forecast. And when you're forecasting on 200,000 or an estimated possible 200,000 jobs, if you're off by 2,000 jobs, it's important to know. But it does skew the news because if Bloomberg had said they expected 212,000 jobs and it came in at 210,000 jobs, their headline's going to read, non-farm payroll report missed expectations. Where if the actual expectation from Thomson Reuters, or that was the biggest service number, was 208, what does the headline read? Non-farm payroll report beat expectations. Okay. So that's why you have to be aware and careful, and that's why I don't look at somebody's opinion. I look at what was. And that's what the economics calendar gives you. Now, so you have your report from your son, and because he's fairly reliable, you set your expectations on this. Wednesday, he comes home with the report card, hands it to you, goes right out the back door to play soccer. You open up the envelope, and what is it? It's all B's. You're shocked, you're amazed, you're happy, you're titillated. You're a happy parent. Again, you didn't go to school and do any analysis. You didn't check with the principal to see maybe they have a new grading system, or maybe he's in new classes with a lower curve, or they switched the way that they use curves to rate the classes. Okay. You know what a B means, and you were thrilled to death. So you're thrilled. You have a what? A very positive reaction. Now, if he had brought you home all C pluses and one B, would you have had much reaction? In other words, saying, well done, kiddo. Now, you holler out the back door to him, say, kiddo, we're going to go to McDonald's for dinner, and we're going to go over to the mall, and you can buy that, that soccer ball you saw in the sporting goods store the other day, because you're happy. And this is what happens with the economic events. When the forecast is better than the actual is better than the expectation, it causes a market action. Okay. At what point, though, is that market reaction enough that it becomes tradable and enough that it will change the level of that asset? Because a lot of times you have this knee-jerk reaction, the asset goes up or down, and then comes right back, and 2 hours later it's back to that level where it was before. So to adopt trading policies, you have to decide whether you're doing short-term trading and you're going to just trade the knee-jerk reaction, or whether you're going to trade longer term because the report was good enough that it should send an asset steadily, not quickly. It's going to go through its violent time, but then it's going to find a new level, which is going to be a little bit, that currency will be a little bit stronger because that report was good. So it's important, and this is why you need to do your research ahead of time. And this is why we talk about building what's called a matrix. This matrix takes into account what we call market neutral, market negative, and market positive. Okay. It also, you see the little pluses and minuses, these are what we call bumps. So the first thing we have to do is determine what we consider market neutral. That is the range that the market, it could be a slightly better than or slightly worse than report, but it won't give you a tradable effect in the markets. Then market negative is the level that it's low enough or missed enough that it will cause a negative reaction in that asset. And then market positive is the number that if it's better than, it should cause a positive reaction in the market. But then because we have these second level reports that are attached to that report, we have to take those into account. But we're not going to analyze the numbers. We're going to take, if the second level meets expectation, we don't have to worry about it. If the second report that's a level 2 is slightly better, we have to say it's a bump. So in other words, you had a report that was in market neutral, but towards the top end of market neutral, and you had a secondary report of that was very good, you could have us actually say it bumped it up into market positive territory. Or you had a report that was slightly in market positive, but then the secondary report was weak, and it pulled it back into a non-tradable or a market neutral effect. So let's go back and look at that calendar again. We're going to look at the jobs report that's due out on Wednesday, I believe it is. And let me pop that up on your screen here. So on Wednesday, we have average earnings plus bonus and claimant count report for the UK. Now I'm going to pop on here and filters, and I'm going to turn back on the level 2 filters. And I'm also going to turn off all the other countries except for the United Kingdom. So we're only looking at that one report. So what we see is, we have average earnings index plus bonus, a level 3, claimant count change, which is a level 3. Then we have the unemployment rate, which is a level 2. Now, level 3s, you cannot evaluate 2 reports by building, you cannot build 2 trading matrices. So you have to first learn what is the most important number in this report. Okay. And that is the claimant count change. Okay. You'll get that by reading the report, doing your research, or figuring it out. Okay. After that, because it's also level 3, is the average earnings index plus bonus. This is the wage growth, because you can't have inflation unless you get increased wages. If the market's starting to get tight and unemployment's falling and jobs are being created, what's going to do is employers have to offer higher wages, so you'll see an increase in average earnings. Okay. And then the unemployment rate is secondary. But it's important because if it has a bump up or a bump down, it can enhance these reports. So what we would want to do is build our matrix around our claimant count and then figure out, okay, because you can't figure out bumps until the report actually comes out. So if you built your matrix based on the claimant count, you're waiting for that number. If you did it on an Excel spreadsheet, you just did that number, and here's our better than, here's our worse than, claimant count, and whatever, drop those numbers in for those reports, and you can see right away whether there's going to be a bump up or a bump down. And in a matter of seconds, once you got this report, you're dropping it in your matrix, and you've already decided what your decision is. If this number comes out better than expected, I'm going to trade the pound, and you're also going to decide what asset you want to trade it against. So you're going to trade the Euro GBP, or maybe you're going to trade the Euro US, the pound dollar. You've already made that decision by your analysis ahead of time. Now, there's one other part to the bumps. And for that, I'm going to go back to let's see if I can see it. Let's see if I can get back to real easily to last week's calendar. Oh, that's because, let me just put the filters back in here. I'll just add the US in here. That should be enough for us to take a look at. Okay. If you look over on the right-hand side under previous, okay, you see greens and reds sometimes in the previous. Okay. Even though I told you the previous was set in stone because it was what last month's report was, last month's report number cannot change. But because these reports come out so quickly to the time that they're being released, we have what we call revisions. So the report was always the number it was, but then it can be revised too because more data for that month happened to come in during the current month. You know, especially when you have holidays and you have some people from big companies that go on vacation, they don't send in the reports, or the reports end up coming in late, or sometimes the month falls in a weird time. You know, the end of the month was on a Thursday and nobody was, and then you hit a long weekend and people were off in the summertime on holiday. So the companies didn't feed the data in and get it all collected fast enough. Or somebody in the government was on vacation, so they didn't do, you know, their little job is one little part of this one little sector, so that sector was missed in the report. But when they came back, they did it and they updated it, and so they released a revision. So when you see greens and red bumps, green means it was revision in a positive manner, red means it was a revision in a negative manner. Those have to be taken into consideration as your bumps also. So these are a lot of things you have to take into consideration to build your matrix. Okay. Once you kind of tried it out and built your matrix, the matrix is very personal. There is no mathematical number I can give you. I mean, I've seen people who go back to, let's find a big report here, back to last month, back to the last 6 months, and they'll come up, because what you want to do is you want to see how that report comes in, what the average is, how much it usually moves by, as well as is it very accurate? Does it normally come in right on the money? Okay. If it doesn't, how much does it vary by? Okay. Then are there adjustments in the previous month? I do what I call eyeballing. Okay. We're looking at right now personal spending in the U.S. It only comes out in tenths of a percent, and it moves in 1/10%, and it stays in a very, very, very small range between 0 and 5%. So it doesn't have much movement. So any variable around the forecast, because it can only come in at forecast, be down by at least, you know, 1/10 of a percent or up by at least 1/10, is going to have an effect on that asset. So right away, you know, market neutral, say for instance, if this report was expected at 0.1%, or here we had the last time, the forecast was 0.2%. You know, it only moves in 0 and tenths of a percent. Right away, you can build your matrix by saying if this report comes in at 0.1% to 0.3%, in between that is going to be market neutral. If it comes in higher than 0.3%, it's going to be very market plus. And if it's lower than lower than 1%, 1/10 of a percent, it's going to be very negative. Okay. Then, of course, you have to take into account the bumps if there is a revision to the previous month. In this case, there hasn't been any revisions. But you see down here in these cases, we had revisions. So like here, back in December 2016, we were expecting a 0.3. It came out at 0.2, which was negative. Okay, so that would have been over in your market negative zone. But what did we got? We had a revision, and it revised the previous report from 0.13 to 0.14. So what that did is that moved a bad report back into market neutral territory because you had a good revision. So imagine if the best way I can explain it to you is, you know, you had a report that came in on Wednesday. Okay, the report was covered a whole week, but the first of the month was on Tuesday. Well, somebody has to break down that report, and if they end up increasing increasing the last month, it decreases this month because overall, if you look at things in quarters or semi-annually or annually, okay, it has less an effect, but it was still it made last month's a very good report, and that could have taken some of the consumer spending because maybe that's where the weekend fell and everybody was out shopping, and that got moved into last month, and so this month was a little bit lighter because of the way the months broke. So there's a lot of things you have to take in consideration, but you could do all of your considerations ahead of time, and that's what's nice about the economics calendar. So real fast, I'm going to take you back over to my PowerPoint because I want to look at what we're looking at on the calendar this week and what we're expecting. Okay, so like last week, the second week of month saw the dollar gaining ground against many currencies despite political controversy. A mix of events awaits us now. We have GDP from Japan. We have jobs data out of Australia, housing data out of the U.S. So here is the big events on the calendar this week. We have Chinese industrial production, and the times are GMT times, not London times. Comes out at 2 in the morning. The world's second largest economy has recently produced some downbeat numbers, so we're looking at that number to be better. The Kaizen manufacturing, and it used to be the HSBC manufacturing, they sold the report to Kaizen this past year, and the trade balance both missed expectations. So will industrial output follow? This is an important event for the Australian dollar. Why? Because Australia exports China is the prime trading partner with Australia, buying up a good percentage of their minerals and export materials. Okay, so Chinese events have a bigger effect on the Australian dollar and then a secondary effect on the New Zealand dollar. So this is one you need to watch. Then on Tuesday, we have Eurozone GDP. Now, overall GDP doesn't really have a big effect on the Eurozone. What we want to do is break it down and look at Germany, okay? Because Germany is the workhorse. So it means if Portugal and Greece, which are doing terrible, or Portugal's doing all right, but Greece, which is doing terrible, does worse than it's been doing, and it might pull down the overall. So you might have Portugal, Spain, and Greece pulling down the overall GDP number. But as long as Germany is doing well, so you want to keep an eye on Germany, and that'll give you a good trade against the pound. Then also on Tuesday, we have U.S. housing data. Now, you have to understand how housing data works in the U.S. because you have building permits, you have housing sales, and then you have housing because it flows from the house is sold because it goes under contract, but it's not closed and becomes a sale. So we want to look at mortgages also. So it's a 90-day, that's on new construction. New construction is between a 90 and 120-day cycle. You buy a house today, put it under contract. You go get your mortgage gets approved. You haven't paid for it yet in the U.S. till you close, but then the builder pulls the building permit to start building on it, and then you actually get the new home sale at the end when you've closed from and the builder's delivered it. So you have to know and watch this whole cycle, and this is one thing you watch because it's very cyclical. You can watch the entire cycle, and one report. So if you can estimate building permits, okay, will tell you how strong the housing market is, but that'll give you a look at what you can expect in 6 months from now, in 90 to 100 to 6 months from now in housing sales. And then we also have, you have new home sales and existing home sales. Because existing home sales is a house that's physically built, somebody lives in it already in most cases, or it's already built. So you buy it and that will close in 30 days. So it's important to look. So building permits is an important piece of that data in that cycle. So you have to understand that and build your matrix accordingly. Then on Wednesday, we have what we've been talking about all day. We have UK jobs report. Let's go back. The U.S. housing number will affect the S&P and the Dow and have a slight effect on the U.S. dollar. Okay. The UK jobs report is going to have an effect on the FTSE as well as the pound. Then we go Wednesday to oil inventories. Oil inventory sometimes has a big effect on the markets. Okay, it's hard to predict because you have to watch what's going on in the markets overall. If we have OPEC, because the EIA report is just the inventory in sitting, in the U.S. and it goes up one week, down the next week, up one week, down the next week, depending on what ships have come and go, where the pipeline's gone, and everything else. But if there's an OPEC deal, it might push prices up, and then if inventory levels are too high, might push prices down. Keep an eye on that. But that's it, oil prices are so sensitive to news these days, it's hard to predict anything. Then you have Japanese GDP. Okay, that's only going to affect the Japanese yen and probably won't even affect the Nikkei. Then we have the Australian jobs report out, and the Australian jobs report will be similar to the way you evaluate the UK jobs report earlier. Although Australia has been doing all right on jobs, the employment rate is at 5.9% compared to Japan's at 3.2, and U.S. it fell to 4.6. It's a little bit higher than it should be, but jobs are overall pretty good. Then we go to U.S. jobless claims on Thursday. Now, the jobless claim is a weekly report. It doesn't have a big effect on the markets, except if it's for some reason we're focusing on it. But we had an extremely good jobs report last week. Unemployment number is way down. So even if this jumps up, there's a whole bunch of statistical reasons it might see a change. It was the first of the month, so anybody who can get laid off was laid off the end of the month. Sometimes it's seasonal. Lots of college kids are taking jobs, because it's summertime, and so companies are firing some full-time employees and bringing in part-time students. So you have to know what to look for. But this is all this on the calendar this week. It's you have a couple chances to trade or look for trade. The best way to do this, and my recommendation is to take 1 month. Don't trade anything. Take 1 month, because the cycle is the same cycle every month long. And start learning to build your matrix. Build your matrix on all the level 3 events. And then see how your matrix worked with the actual and the market reaction, because then you can start learning how to adjust your matrix. Because once you learn these events and you understand them and you've built your matrix and you know how big you expect your market neutral, market positive be for that particular asset, you'll get a feeling for these and you'll be able to do them faster and easier, especially once you've done the research. Once you understand what the reports are, how they're effective, what size, because off the top of your head, could anybody out there tell me what you expect in new home sales in the U.S. as compared to new home sales in the UK? It's an ungodly number. Over 1 million houses in the U.S. UK is a couple 100,000. You'd have no idea what to expect in those numbers unless you did some research. So after a month or two, you'll know exactly what they are. You'll be able to, you'll know what the ranges are. You'll know whether they're big numbers, small numbers. You'll get to know whether they're in whole number reports. You'll understand what PMI is and what the divider line is for PMI and why this is so crucial, and where these numbers are, where they should come in at, and understand them. So the economics counter is a very good tool. And then join us next week, because we'll be analyzing next Sunday all the data on the calendar all the way through the UK elections. And we won't be talking about how to use the calendar. We'll actually be doing the analysis together, building a couple trading matrices. So thank you very much for joining us tonight. Have a great trading week, and thank you for being part of the ETX family. Have a good evening now. Good night.